first of all, we're going to get into what's happened in the Reserve Bank. It has kept the cash rate on hold at 4.1%. Governor Philip Lowe's penultimate board meeting or penultimate decision was made today. Let's bring in Business Editor Ross Greenwood. Ross, there is still a very cautious note within this decision that this might not mean rates are on hold for good or even coming down in 6 or 12 months. There's the option there still on the table from the RBA to have another squeeze, if you like, on the brakes.
There's no doubt about that, Tom, and a few things that it really highlights in the statement today. One is that while goods price inflation is coming down, so in other words, think about your petrol prices, think about a range of foods, different things that are falling in price, is being offset significantly by rises in prices in a lot of services, and in particular rents is one that they do highlight today. A second aspect of this is obviously there is ongoing pressure on wages, and so as a part of this statement today, the Reserve Bank has reiterated its forecast that it expects the unemployment rate is going to rise from around 3.5% to 4.5% by next year. So when you consider that rise in unemployment is something that unions, probably even the Treasurer, would like not to actually contemplate because it means more people under financial stress, it is something which the Reserve Bank now sees as inevitable if inflation is to be brought into control. Now, it's just interesting also to note that the Reserve Bank in its final statement simply says that more rate rises may be needed in order to bring this inflation down. Their idea still is to try and glide this inflation rate lower out until about 2025 to try and preserve as many jobs as it possibly can, while at the same time, and it makes the point here, of killing off the inflation because it says long term that is going to be more detrimental to Australian businesses, families and to the overall economy.
Yeah, and yet, just briefly, noteworthy as well that it did have a note within this from the RBA that the new estimation is that the target band will be reached in late 2025, not mid. So is that more just a recognition of maybe supply chains and global issues? Because otherwise it would want to get it under control before that.
Well, there's no doubt. And the idea, if you wanted to get it under control before then, would to be continuing to raise interest rates. But as I say, this so-called glide path that the Australian economy is on means that you put up with higher inflation for longer. But it also means possibly that you also have to put up with the higher interest rates for longer as well. That if that is a glide path, that many people expected interest rates could fall this year or maybe early next year. Well, it may be until late next year until you do start to see the economy falter and indeed these interest rates fall. Now, I can show you what happened on the money markets today because that's where there was a bit of quite dramatic action. As I said earlier, economists and the money markets were split. And so if you go to the one-year bond charts, you actually see that the yield there fell quite dramatically and suddenly off the back of this decision today. Same thing for the Australian dollar. You can see here's the bond yield. Look at that. It's down quite sharply off the back of the decision. If we go to the dollar as well, similar story there. Have a look at the dollar. It dropped around a third of a cent after that decision today. So again, money markets really saying that there is something of a surprise in this RBA decision today.